So the wheel strategy is one of my main trading strategies. It's one of the ways I try to generate income while I stay patient. The idea is simple. I try to get paid while I wait for a stock at a price I'm willing to own it at. And then if I do get assigned those shares, then I wait and get paid while I hold them. That's the wheel strategy. And in this video, I'm going to show you exactly how I do it, how people mess up, how I messed up, why this strategy can work, and really how to do it on the right stock. That's going to be the key thing. You can get kind of caught up in premium when you're trading the strategy, which I've done, and you can get into stocks that are a bit questionable because you're chasing premium. So I'm going to show you all that in this video. Sit back and enjoy.
Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions.
So before I get into the steps, let's make this real simple. The wheel strategy is basically an income loop built around patience. One step, you sell a cash secured put. Step two, if the stock drops and you get assigned, you buy those shares at the price that you selected, and then you own those shares, 100 shares. Step three, once you own those shares, you sell covered calls on those. And step four, if the shares get called away, the cycle repeats itself. It can go back and forth, selling puts again, selling calls, selling puts. It's the wheel strategy, as you can see in the diagram above here. So when people say the wheel, that's all they really mean. They're selling cash secured puts, they get assigned, they sell covered calls, they get assigned, and this process repeats. It's very simple. So a lot of you probably already know this, but the first step in the wheel is selling the cash secured put. I've mentioned it before, but what you're basically saying is, I'm willing to buy a stock at a certain price. You set the price, you set the stock, and you choose these stock or these strike prices for certain reasons, whether it be a certain delta that you're looking at or a certain percentage. Um, Maybe you're in a hurry. You kind of want to own these shares quickly. You think there's something big coming up. There's all kinds of reasons why you might want to sell at a certain strike, but typically you're just selling that at a strike price that you pick that you're comfortable with. It's on a company that you want to own anyway. So if you get assigned shares, honestly, that's kind of like the best scenario for me. I want to be assigned shares when I'm selling covered call or cash secured puts because I know that if I get that company at the the, the price I want when I want it, then my trade plan's intact. And now I could start selling covered calls and collect that capital appreciation on the way up. So you want to make sure that you understand that when you sell a covered call, you're you're saying to the buyer that if this price gets down below a certain level, I'm willing to buy those shares. Those are 100 shares per contract. That's kind of how options work. Everything's done by 100. So if that share price drops below your strike price by the time your expiration hits, you get assigned those shares. Basically, you have to buy them. Your broker will put aside whatever money necessary to buy 100 shares for you. And if you get assigned, it just kind of transfers over. You don't lose the money. It's just now you own the shares. So, before your money was being held And once you get assigned, now you own the shares. It's that simple. So this is where a lot of people get this strategy wrong. They think assignment means that something went wrong or something, and not necessarily. If you started with a stock that you wanted to own, then you chose a strike price, then assignment is not failure. It's part of the plan. So when you buy shares at a price that you wanted, the premium you collected, uh, it lowered your cost basis. So when it lowers your effective cost basis by collecting that premium. Your thesis is still intact. Then you just simply move to covered calls. So that's why the starting point matters so much. You find areas on the chart where you say, okay, this stock I think is can get to this level based on uh, you looking left on the chart and you seeing support zones where you think that stock is going to kind of gravitate to. Um, when you're selling these these wheels, the idea for the most part is you want the stock to stay flat or slightly up or slightly down, depending on your strategy. You take you're collecting premium and you use time decay in your favor. So a lot of times, if the stock stays flat, the worst case scenario is that you only collect your premium if it stays flat. Now, if you're in a strategy and the stock either dumps or rips higher, then then that's where your risk lies. But getting assigned is definitely not something that I would consider being a failure. Okay, so once you own the shares, now you can start selling covered calls. Here, you're going to be getting paid while you hold these shares. Uh, Hopefully, while they're going up slowly, collecting capital appreciation while you earn extra income. It's like that extra dividend layer in my previous videos, what I talked about with that. So you sell a call at a strike where you'd be okay having the shares being called away now. Now you're looking above the chart a little bit. Where can this price action go? Where can this stock price rise to? Those are where you want to kind of start selling your covered calls at. You want those resistance areas to be your targets. Um, Worst case scenario here on a flat stock, a company that's moving sideways is again you get to keep premium and you just collected this premium over and over and over. If you get your shares called away, you the somebody's buying your 100 shares at the strike price that you chose. You kept the premium no matter what happens. You always keep the premium. Cash secured puts, covered calls, no matter what happens, you collect that premium up front. That's yours right away, and that's just the way it works. You get that premium right away. That's how you get paid. And if you're correct on the direction of the stock and the speed of its movement, then you just keep rolling this strategy over and over and over again. If premium is weak on a covered call, if you see that it's not really worth selling a covered call and risking the upside exposure, just sit on your hands. I oftentimes am sitting on my hands with 100 shares of stock or however many shares of stocks I have. I feel like I can be placing these calls, but when you look at the premium and you realize that it's just not worth selling those covered calls at the premium um, that it's giving you. And honestly, just sit on your hands. I've found that when the premiums are lower, a lot of times that's when the stock kind of goes high fast. So this is one of those areas where sitting on your hands is actually a good thing. Now, here's where the biggest warning I can give you: uh, don't do these strategies on garbage stocks. High premium is not the same as high quality, and I've learned this the hard way. Uh, Big premiums can hide big risk. If the business breaks, the wheel can break right along with it. So if the company is weak and the premiums um, kind of lure you into owning something that you really didn't want to, but you saw that it was like huge premiums. You're like, oh my god, I can make a whole bunch of money here, and I'm gonna sell these cashier puts, and I'm gonna collect all kinds of money on this thing. But the truth is on very high volatile stocks that are kind of garbage. My biggest warning is just honestly, I personally would stay away. That's what I do. I don't chase premium. I used to. I did, but I've learned, and it's always most of the time it's better placing the wheel strategy on companies you truly want to own and you've done your research on. Those are the best two things I could tell you. But don't try to chase yield all the time. At least I won't. So let me give you an example of how I think about this right now. So I already have positions on APLD. I sold cash secured puts on APLD. And if I get assigned at the price that I wanted to pay for these shares at the time I wanted to own them, and if I get assigned on those and my thesis still holds, I can just move into the covered calls and start the wheel. That's the whole point. The point is not to force a trade. The point is to use a wheel on a stock that you understand. And honestly, that's the big difference. The strategy works better when you use it on stocks that you already own. I do this a lot. If you look at my portfolio, a lot of my stocks, companies that I own, are in lots of 100. So like, maybe 500 APLD, six 700 Robinhood, whatever the key, 100 increments. And the reason why I do that is because I could sell cash secured puts, or I mean covered calls on those shares, and a lot of times I stagger my entries. So like if I want, maybe I'll have a couple that are going a week out at like a 25-30 delta, depending on my average cost basis. Or then other times I'll go out even 35 days, put one or two of them on, collecting premium. So I stagger and move my strikes a lot. And a lot of times, if I get to a level where it's like 50% profit within a day or two, I will almost always buy those back, keep the premium, redeploy that covered call at different strikes. So I'll just keep moving my strike up. It's almost like, in a way, kind of like a stop loss that you're trailing stop loss. In a way, it's sort of how I kind of run it. I keep collecting this 50%, 50%, 50%. A lot of times, if the price of the stock starts going down, that's when I may not take that 50%. I'll hold it a little longer, especially if I don't have any other reason uh, to move around or get out of that position for that reason. So those are just a couple things that I do. So if I had to sum up the wheel strategy in one sentence, it would be this: the wheel is not magic; it's a process. You sell puts on stocks you want. You welcome assignment. If your thesis still holds, and you sell calls with a plan, not out of desperation. That's really the whole thing, honestly. The strategy is about getting paid for patience, not chasing hype, not forcing trades, not pretending premium alone makes a good trade setup. If you found this helpful, subscribe to more practical income investing content. If you want the tools that helped me stay organized, I have a free trade journal waiting for you at practicalincomeinvesting.com. I'll also include a link to the other video that I made showing everything about that site in my market compass and the free trade journal that's waiting for you. It's a great trade journal, by the way. So thanks for watching. I'll see you in the next one.